You're sitting at dinner with your family, and your uncle starts talking about how he made $3,000 in the stock market last month. Your cousin chimes in about her 401k. Your coworker mentions buying shares of some company you've never heard of. And you're just nodding along, pretending you understand, but honestly, you have no idea what any of this actually means. You know the stock market exists. You know it has something to do with money and companies and getting rich, maybe. But how it actually works? That's a complete mystery. My name is Zach, and I spend way too much time thinking about money, investing, and why something that affects almost everyone's financial future feels so unnecessarily complicated. And here's what I've realized. The stock market isn't actually that complex. It's just explained terribly. People either make it sound like rocket science, or they oversimplify it into useless advice, like buy low, sell high. Neither approach actually helps you understand what's happening. So I'm going to break down what the stock market actually is, how it works, and why it matters to you, even if you've never bought a single share of anything. Because once you understand the basics, a lot of financial decisions that seemed scary or confusing suddenly start making sense. Let's start with the simplest possible explanation. The stock market is just a place where people buy and sell tiny pieces of companies. That's it. When you hear someone say they own stock in Apple or Tesla or whatever, they literally own a small piece of that company, not the building or the products, but a percentage of the business itself. And the stock market is where those pieces get bought and sold every single day. Here's how it works in practice. Let's say you start a lemonade company. You've got a great recipe, you're selling tons of lemonade, and you want to expand. But expansion costs money. New equipment, more locations, employees. You need, let's say, $100,000. You could take out a loan, but loans have interest and monthly payments. Or you could do something else. You could sell pieces of your company to other people. So you decide your lemonade company is worth $100,000 total. You divide that into 10,000 shares, which means each share is worth $10. You keep 5,000 shares for yourself, which means you still own half the company. Then you sell the other 5,000 shares to other people for $10 each. Boom, you just raised $50,000 without taking on debt. Those people who bought shares, they now own pieces of your lemonade company. If the company does well and becomes more valuable, their shares become more valuable. If it fails, their shares become worthless. That's what companies do when they go public and start selling stock. They're raising money by selling ownership to regular people like you and me. And the stock market is where all this buying and selling happens. Now here's where it gets more interesting. Once those shares exist, people can trade them with each other. Let's say your lemonade company starts crushing it. You're making great profits, expanding to new cities, everything's going amazing. Suddenly, people want to own a piece of this company. Someone who bought shares for $10 each might now be able to sell them for $15 or $20 because other people think the company's going to keep growing. The company itself doesn't get that extra money. The original shareholders do. That's how people make money in the stock market. They buy shares hoping the company will do well, the share price will go up, and they can sell for more than they paid. But it also works in reverse. If your lemonade company starts struggling, maybe a competitor shows up, maybe people stop drinking lemonade, whatever, those shares might drop to $5 or $3. Now the people who bought at $10 have lost money. They can either sell at a loss or hold on to the shares, hoping the company recovers. This is all happening constantly, every single day, with thousands of companies. Apple, Microsoft, Amazon, Netflix, all publicly traded companies with millions of shares being bought and sold. And the price of each share changes based on what people think the company is worth. Not what it's actually worth right now, but what people believe it will be worth in the future. That's the key thing people miss. Stock prices aren't just about current profits. They're about expectations and predictions and sentiment. Think about it this way. If Tesla announces they've invented a battery that lasts twice as long, the stock price shoots up immediately. Not because Tesla made more money today, but because investors believe this invention will make Tesla way more profitable in the future. They want to buy shares now before everyone else realizes how valuable this is. That's why stock prices jump around so much. They're constantly adjusting based on news, rumors, earnings reports, economic conditions, and what investors think is going to happen next. So, who actually sets these prices? This confused me for the longest time. There's no person sitting in an office deciding that Apple stock costs $180 today. The price is determined by supply and demand, just like anything else. If more people want to buy Apple stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. It's an auction happening in real time, millions of times a day. Here's a simple example. Let's say Apple stock is trading at $180. You want to buy a share, so you place an order. At that same moment, someone else decides they want to sell their share. Your order and their order get matched, and boom, you just bought a share of Apple for $180. But if nobody wants to sell at $180, you might have to offer $181 or $182 to get someone to sell to you. That tiny increase multiplied across millions of transactions is what moves the stock price. Now, here's what actually matters for regular people. You don't need to understand every complicated detail to benefit from the stock market. You don't need to pick individual stocks or day trade or watch CNBC all day. Most people invest in the stock market through index funds or retirement accounts, which basically means you own tiny pieces of hundreds or thousands of companies all at once. When the overall market goes up, your investment goes up. When it goes down, your investment goes down. And historically, over long periods of time, the stock market goes up. Not every day, not every year, but over decades, it trends upward. That's why people say investing in the stock market is one of the best ways to build wealth. Your money grows faster than it would sitting in a savings account, and you're literally owning pieces of the companies that run the world. But here's the reality check. It's not free money, and it's not without risk. Companies fail. Markets crash. If you invest money you need next month, you could lose it. The stock market rewards patience and punishes panic. The people who make money are usually the ones who invest consistently over years and don't freak out when prices drop. I want you to think about this. Every dollar you're not investing is a dollar that's slowly losing value to inflation. Money sitting in your checking account doesn't grow, but money invested in the stock market, even conservatively, has the potential to double every 7 to 10 years on average. That's not speculation. That's historical data. The difference between someone who starts investing at 25 versus 35 can be hundreds of thousands of dollars by retirement, just because of how compound growth works. Getting started isn't complicated. You don't need thousands of dollars or a finance degree. You can open an investment account in like 20 minutes, put in $100, and own pieces of the biggest companies in the world. The barrier isn't knowledge or money. It's just the intimidation factor. And once you understand that the stock market is just people buying and selling pieces of companies, that intimidation starts to fade. So yeah, the stock market is basically organized ownership trading. Companies need money, they sell shares, and those shares get bought and sold based on what people think they're worth. It's not magic, it's not gambling, though it can feel like it if you don't know what you're doing. It's just the mechanism through which regular people can own pieces of businesses and benefit from economic growth. And understanding that might be one of the most valuable things you learn about money.